Hello, and welcome back to Cash Flow Conversations, a podcast series sponsored by our friends at Nova Credit. If you followed my work, you'll know that I'm obsessed with cash flow data because of its enormous potential to positively reshape lending in the US and around the world. Cash Flow Conversations tracks that shift from theory to practical use across the lending lifecycle. Now, it's been a while since our last episode in this series was published, way back in September of 2025. But here's the thing, my interest in this subject truly is eternal. And thanks to the good folks at Nova Credit, we have decided to transform this podcast from what we had originally intended, which was a limited mini series, to an ongoing series, a place where we can post all the most interesting conversations that I have with folks in and around the cash flow lending ecosystem. Today's episode was recorded live at Money 2020 in October of last year. I had the opportunity to sit down in person with Doug Swift of Navy Federal Credit Union and Chris Hansen of Nova Credit, who's been on this show before. We talked about the use of cash flow data in lending and how it has evolved over the last 18 to 24 months. Now, put simply, it's evolved a lot. It's gone from being lenders' best kept secret to an infrastructure supported tool that's getting real traction. Loan vintages have matured and the use cases have expanded. We now have second look underwriting, line assignment, portfolio management, delinquency support, loan rewrites, extensions, settlements, credit line changes, just to name a few. And Doug brings it all to life with examples from Navy Federal Credit Union, including in particular from collections, which is one of the areas that I am most passionate about seeing cash flow data infiltrate. It was a great conversation. I was thrilled to get the opportunity to moderate it, and I can't wait for you to listen to it. So without further ado, here's our latest episode in Cash Flow Conversations. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right. Well, we're going to get started. This is Coffee and Conversation. Chris here has coffee, so he's got us covered there. And we are going to have a great conversation about cash flow analytics, which is my actual favorite topic to talk about. So I'm delighted to get to moderate this discussion. My name is Alex Johnson. I write the Fintech Takes newsletter. I'm delighted to be joined by Doug and Chris. Probably everyone mostly knows you guys, but why don't we do quick introductions? Doug, why don't you go first?
Sure. Thanks, Alex. So Doug Swift, I work in lending at Navy Federal, have been a partner with Nova at several companies now, and I've gotten to know Chris through that. And so excited to have the conversation today.
Awesome. Nice to see you all. Thank you for coming. I'm Chris. I work on cash flow analytics at Nova Credit. I've been helping build that for better part of 4 years and work with many in the room. So thank you for coming out. And for those of you we have not had an opportunity to chat with, there's a couple Novans floating around in the room too. So please find us.
Excellent. Okay. So Chris, I feel like I ask you this question on a rolling 6-week basis, but we'll do this again now that we're here together. Can you kind of help us just level set and characterize where we're at with cash flow underwriting and the adoption of cash flow underwriting? In particular, the frame I want to use for this question is kind of what's changed in the last 18 to 24 months.
Yeah. I want to say we do talk about this nice and frequently. You are truly a cash flow underwriting fan. I would say I'll take that in two parts. One, I just like to say that cash flow underwriting used to be, a lot of lenders and issuers' best kept secret. They've been doing cash flow underwriting for a number of years. And I would say the systemic change in infrastructure has caught up to a lot of what a lot of lenders have been doing. And so because of that, it's become more and more ubiquitous across the board. The vintages have come to bear. The proof is in the pudding. People are actually originating to a large degree and then understanding where they can leverage open banking across multiple dimensions. Two things have changed. One, many lenders who have used cash flow data for purposes within things like origination have started to think more and more about how do I expand across multiple use cases in my consumer lifecycle. I know the data is valuable. Where all can I use it and where all can I get it? And then also, clearly, the open banking dynamic, which we could probably spend a whole 30 minutes on. over the last 18 to 24 months certainly changes some of that as well, which is an ebb and flow of how will cash flow data permeate across the industry, but the value is clearly there across the board.
So, Doug, I want to get your take on that question because, we're going to get into cash flow servicing. We're going to get really into cash flow servicing, which I'm very excited about because it's a passion topic of mine. But before we do, you've worked in lending in a bunch of different capacities over many years. How have you seen sort of the evolution of the use of cash flow data?
Yeah, I think when I think about cash flow, my first experience with cash flow was about a dozen years ago on the small business side. If you think about the merchant and the commercial side of things, cash flow has been a key tool that has been used there for years. And it's really kind of in the last 4 or 5 years that it's really started to evolve more into the consumer side of things. And I think to the point that Chris made, it's taking hold there. But I think as it's starting to take hold on the consumer front, it was originally a underwriting second look type tool. And now it's migrating towards line assignment, portfolio management, and even delinquency management side of things. And so excited to talk more about that.
Well, let's dive into that because that's I've been just waiting for the industry to get to a point where we can have this conversation, and now it's happening. I'm so excited. So, we were joking outside. Member support, is that what we're calling it? Is that a good?
We can go with that.
Good
Sure.
name. Okay, all right. So, member support, collections, delinquency, whatever we want to call it. I'd be curious to understand how you're exploring the use of cash flow data in that space, because one of the things I've been thinking a lot about is we sort of just make do with the tools we have, right? And we know that cash flow data is extremely valuable and additive to credit bureau data. But I think in some kind of larger senses, credit bureau data is actually fairly useful and sort of a natural fit in underwriting, whereas I've never really found it to be particularly a good fit on the delinquency servicing side. And I think cash flow data, by contrast, is really particularly powerful there. What are you guys looking at, and how are you thinking about them?
There's a few places where we're looking at using it more, but specifically as I think about the self-service side of things in places like collections. So members or consumers, if they're in collections, generally they either came in with bad intentions to begin with and you're not going to get contact with them, or they're pretty ashamed of what's happened, what their circumstances are, and where they want to or they don't want to engage because of that embarrassment or the feelings that come out talking about it. And so by being able to incorporate things like cash flow tools that are automated, we're actually able to offer them extensions or interest rate reductions or rewritten loans or even settlement offers because we're actually able to get information from them that helps us craft the right plan for our members. But we can do it in a way that doesn't involve them spending minutes, hours, days on the phone with us. So if I drill in a little bit more on the settlement side of things, right? By the time you reach the delinquency stage where you're actually talking about a settlement, you've probably heard from us several hundred times. You have, probably are negotiating with multiple lenders and going back and forth on the phone where we say we'll settle for 80%. You say I can't afford that. We go back and forth. It's not the best member experience, but it's also not the best team member experience. And so as we roll out self-service tools in everything that we do, we see more and more member take up. And so bringing this into the settlement side of things, if members are able to negotiate a settlement based on information they supply through cash flow underwriting or cash flow data, we're actually able to give a single offer that we can both be happy with and not have to go back and forth and extract that emotion and feeling that comes from doing it live.
So I hadn't thought about it that way, but that's really interesting because if I'm understanding you correctly, what you're saying is a big part of the initial conversation that you have when someone falls into delinquency and you're trying to figure it out is really information gathering for you, right? Because obviously you know that the consumer has fallen behind, but you don't know any circumstantial reasons as to why that is. Like you don't have any insight. And so to craft any intervention, offer, settlement, whatever it is, you first have to know that. And it sounds like with cash flow data, that data is just there and you have it, and that becomes the raw material for something you can present more proactively or in a self-service channel.
Completely. And I think the other thing that we're lucky enough to have at Navy Federal, we have a team we call PFM, but it stands for Personal Finance Management. It's a budgeting, kind of debt management function that we've invested in to help support our members. But in those conversations, they will take upwards of 40 minutes or an hour, because you're going to go line by line through a member's budget. You're going to go line by line through what they're spending money on, where the money's coming in. By introducing more automated tools in advance of those calls, we can shrink them by 75%, and they become a 8 to 10 minute call. And if I think about that from a member perspective, let's have a hypothetical member who may be working 2 jobs and needs the assistance, but doesn't have the 40 or 45 minutes to dedicate towards that phone call. If they can just provision some information to us, it can become an 8-minute phone call that they could do on a break from one of those jobs. And so we do 150,000 counsels a year today, helping members who are in financial distress. They may be delinquent or they may be pre-delinquent, but it's a big place where we invest. But if we can double that number, because it's A, more self-service, and B, shorter, that they're able to actually use time of their day that they're able to get in there, we think it's going to just continue to provide exceptional experience for our members.
This episode is brought to you by Nova Credit. Every lender wants better credit data, but most don't need more data, they need more connected data. Nova Credit's FCRA compliant platform gives you unified access to credit signals across global credit bureaus, bank transaction data, payroll providers, and verified documents. If you're expanding into cash flow underwriting or reaching cross-border borrowers, Nova Credit makes the complex stuff of credit data usable. Learn more at novacredit.com. Chris, I just feel you wanting to jump in. Jump in.
It's you just can sense my wanting to just get in there. It makes me think of, just from a member experience standpoint, it makes me think of conversations I've had with actually the legend Ash Gupta, talking about financial crisis and understanding what it means to retain a member, and like how actually trying to understand their position. We encourage all lenders to think as consumers. Wouldn't it be a better experience if you had an unexpected expense to come through in your account for a lender to say, hey, we see this, we understand it, we're going to tailor our program for you. We're going to tailor that payment because we understand what situation you're in. We understand your financial history. That retention goes so far in building good faith with your institution that brand equity for you is exceptionally way more valuable, so long as you can nail the messaging to the consumer than actually sitting there and trying to go through collection. So collections in particular ends up being this really interesting spot in cash flow underwriting, where a lot of conversations start with, well, are people going to plug in a bank account to go collect debt? Right. And there's a difference there. There's nuance, certainly, on whether you already have cash flow insight and you're proactively doing that, or the messaging on a reactive basis, which is super critical to a consumer and understanding, we need to make sure that we're tailoring the message to my customer.
Yeah, I'll keep this brief, but
no, please go ahead.
We talk about at Navy Federal, the members are the mission. Everyone's heard that tagline if you've seen any of our commercials. But part of how you make them the mission is personalization. And so by having that data provisioned both proactively and reactively, it allows us to drive that personalization that allows us to give them what looks and feels like a custom experience every time we engage with them.
Well, and that's something I want to drill down on just for a second, because it does feel like, and Chris, you brought up this idea of like, well, okay, if it gets to the point of needing to collect, is a consumer going to say, okay, you want to collect debt from me, I don't want to pay, plug in your banking information? Well, no, of course they're not going to do that, right? Like if you present it in the wrong context, it's not going to work. And I actually feel like even in the origination process, we see similar things sometimes, right? Where it's like, if you plug it in the wrong place, you're going to be creating an adverse selection problem for yourself, right? But that's just a question of experience design and where you put this. And it seems thematically that one of the things a lot of institutions are doing pre-origination, post-origination is sort of reconstructing or building larger experiences that cash flow data and provisioning of that information plugs into, but it's in the context of we're trying to help, we want to provide guidance. And I would guess, and maybe Doug, you can jump in here first, that when you're designing those larger experiences, A, you get better uptake because the value proposition you're presenting to the user is different. And B, it allows you to engage more proactively as opposed to waiting for something to happen.
Absolutely. I think the most common use case everybody talks about for cash flow underwriting is second look, or being able to approve someone you otherwise wouldn't be able to approve. But I think some of the stuff that we've looked at is not just the second look side, but the yes and. Hey, we can approve you for this credit card today, but with this additional information, you can get a larger line. Or maybe it goes from being a secure card to an unsecured card. And so all across the life cycle, from acquisition through portfolio management when it comes to credit line increases or credit line decreases, or through the stage of delinquency, it's about the what's in it for me, for that member or consumer. And so it's not just the yes, no decision at the front where we can use this powerfully. We can actually leverage it to give a what's in it for me throughout the life cycle for a member.
Chris, talk a little bit about the analytic insights from an account management, servicing, collections perspective, and how it differs from traditional credit data.
Yeah, definitely. The personalization, I think, hits it spot on. That's really what we're doing here with cash flow data. From a risk standpoint, you're making this ebb and flow and this persistent access and visibility into a consumer's repayment behavior, and frankly, their behavior writ large. Part of the core benefit of cash flow data and open banking data is having real-time access to insight. And so I think you hit the nail on the head earlier. Bureau data has a furnishing cycle. It will take time. So when you look post-origination, you can pull that data and you can buy a report from a bureau as frequently as you want, but there is only so often that furnishing cycle will complete. And so you're playing some version of whack-a-mole or catch-up in account management, whereas you might be able to pull that data in real time or have access to the data already, so you can get a warning flag, a trigger that somebody is under distress and their patterns and their actual velocity of transactions has shifted in the expense and inflows. And so those types of things really are insights that you can start to glean. Also, fraud is a really interesting area as well.
We were talking about that outside. Yeah.
When you look at persistent access to an account, somebody who's an account holder for you, understanding, again, on a personalization component, that there might be some fraud signals, either intentional or unintentional, can provide quite a bit of insight. So certainly credit risk insight, more real time, understanding things like delinquency insights, as well as your general credit risk proxy, right? Just like you pull a bureau file traditionally for things like origination or account monitoring, cash flow data can do the same thing, but more real time. And then also get you the breadth of insights around things like, is there something happening fundamentally to this account or this consumer financially that I should be aware of? Something like fraud.
Well, and Doug, I want to get your take on this, because another thing you mentioned that I think is really interesting in this context is when a consumer's under financial stress, they have other obligations besides just the ones they have with your institution. And I would think that to a degree, it's funny, sometimes collections becomes very adversarial that way, pay me, don't pay this other person. But it would seem from the member perspective, and you guys are obviously very focused on doing what's best for the member, you almost want to have a more holistic conversation about we want to help you figure out the right order in which to do this that's optimal for you. And that might mean putting us a little lower down, or it might mean doing this first, but then we would suggest this. So how do you think about that, broadening that conversation and not making it just pay us back, we don't care about anything else?
Yeah. So using a real example, we had going back to the personal finance management side of things, we had a counseling session with a member who had multiple card issuers that they were behind on, but they had a mortgage through us. And through the counseling session, our counselor was able to determine they had a decent amount of equity in their house. And so rather than continuing to revolve at 33, 34% on those cards, we were able to guide them towards, hey, a HELOC could actually help you here, and actually allow you to consolidate that debt and leverage that. Now, the heartstring side of this is after that counseling session, they did apply, they were approved, and she then called the counselor back crying, so excited that she was able to do this. But where I think about having this level of analytics and data is how many more folks can we do that for? Or where are there places that we can say you have other vehicles you can leverage? I think far too often people rely on what they know or what they read on the internet. And so having these additional levels of analytics and insight allow all of us to give a tailored message that helps the member or the consumer get to a place that they have that joyous moment where they're actually relieved of the burden that had been hanging over them for 60 or 90 days up till then.
And I'm guessing this is also great for the folks who work at your institution and have these conversations, right? Like this is the type of conversation they want to be having, the type of help they want to provide to members.
Totally. I won't belabor the point, but let's just say when the counselor heard the tears and the excitement, he screamed out, and then the whole floor came running over asking what was wrong.
Oh, that is so cool.
But it was a really great, touching moment that we were able to assist a member who had been stressed clearly, and got celebrated. Actually, went all the way to the board in terms of listening to that call because of the level of celebration that came out of it.
That is pretty cool. Chris, you mentioned kind of the way that you can just continually pull bureaus whenever you want, even though it doesn't necessarily give you the most up-to-date information or the most useful information. Obviously, the provisioning of this data, the persistence of this data, that's something you guys have been working a lot on. We referenced, although we won't get too deep into the open banking regulatory side of all this and the uncertainty there. But just generally speaking, I think I've heard you describe it before as like, there's just sort of a natural way the market is likely to evolve based on the way this has to work. Can you sort of explain that side of it and how you envision the sort of consumer permissioning process evolving to support some of these use cases?
Definitely. Yeah. It's, many of you in the room are either actively on your relative open banking teams within organizations or adjacent to and working with many of them in terms of like, will this data be made available? And the best place to look is inside. Are you guys making your data available to one another? Is that infrastructure actually coming to bear? And there's certainly some nuance there. So I usually describe the evolution of this to some degree. People have seen the trends of consumers wanting more personalized experiences and using their data elsewhere. There's a philosophical question for many different institutions, but I would say the vast majority have understood that a consumer is going to take that data and try to use it across their ecosystem, and that will benefit you as a financial institution, as a depository institution. So like making that data more available to that consumer creates a stickier and better relationship for you. It won't necessarily create, an adverse action within your organization. Over time, 1033 comes through. There's more pressure on that. People are starting to gear up to make that data available. A lot has happened with the CFPB since then, which has now resulted in a lot of institutions saying, what is our principle? Are we making the data available? Are we not making the data available? Do we make certain data available? Do we charge for data?
It's kind of more of a question of like, what do we believe as an institution as opposed to what we're mandated to do?
Right, exactly. And so there is this, I would say the common belief when we work with a lot of the depository institutions, I think you're seeing this play out, is the data will continue to be made available one way or another. And the question is like, what part of that spectrum are you going to sit on? And like, how are you going to approach that with your members? And so that is, the trains left the station in terms of the data being made available, and the value there is, immense. I would say the conversation I have mostly with teams, and in particular open banking teams, is great. We know the data is going to need to be made available out from our institution. How do I focus on the data in? What's the value I can get now in, and how do I bring my institution along on that journey? And that's where things like cash flow underwriting are so impactful for your bottom line, for your ROI. As Doug mentioned, things like second look underwriting are a great way for people to get started. But across the board, this is the breadth and depth conversation. Where do you actually acutely get started for the use case and find the largest amount of lift? And then where can you penetrate this to make it a core part of your strategy in acquisitions and risk management?
I think just to pile onto that, thinking about what I said before in terms of the what's in it for them, consumers by and large are going to do things that will benefit themselves. So it's up to the institutions to be able to actually articulate the use cases and the reasonings for it to the consumers. And so using a Navy Federal example, we have a program called My Making Sense, where it's a self-service tool that helps on budgeting and Think about it like your credit monitoring services. And there was initially some questions around how many members are going to uptake on this. And as we laid out what the benefits were, we continue to see hundreds of thousands of members a month continue to enroll in this because we've been able to articulate what the benefit is, and generally then the consumers want it once they understand what those benefits are.
Yeah, I mean, to that point, I actually really do like the idea that with consumer permissioning, it sort of holds institutions accountable for clearly articulating the benefit, right? I think sometimes we get a little lazy about like, well, just check this box. You're not going to read the terms and conditions, and that'll give us the approval we need. And like, that's fine. And legally, you're probably on safe ground, but it's not the right way to communicate with your customers or your members. And it's not the right way to design experiences, right? Like if you can't build a product or experience that a consumer is willing to power with their data when they fully understand the benefits of that product or experience, it's not good enough, right? And so the idea that like we are holding ourselves accountable to explaining, getting, and maintaining that permission, I think is really, really important and actually a benefit, regardless of where we land with open banking. Wrapping up, last question I want to ask you guys is, from an organizational readiness perspective and kind of making the case for this, again, underwriting and origination is where everyone wants to start. Quite frankly, it's where the money is made, right? And so like that is just an obvious place. If I can show you lift there, the business case kind of writes itself. I am so excited about servicing and the stuff that happens after origination because I think it's more impactful for the end customer or member. But in some senses, I think it's also a harder business case to make. And so I'd be curious, and maybe Doug, will start with you and then Chris, how do you make that business case? How do you drive that sort of organizational alignment?
I think two things there. And obviously I can't speak for every institution as each one is different. But within ours, a big benefit is our focus on the membership. And so continuing to be able to articulate the speed it helps the members with, the level of depth we can go into our conversation with the members, that's a key part of the business case that kind of sells itself. The angle that I have also used or continue to focus on is, as we think about some of the servicing cases, if you're using it at acquisition, we can get hurt, right? If you think about it, we could book a bad vintage, we could misappropriately adverse action. There are lots of both financial and regulatory ways you can get hurt. If we're actually using it on more of the servicing side, we already know what the member is. If they're in collections, the delinquency is already on our books. It's really about how we're actually able to recover that delinquency or roll back that delinquency. And so
it's like lower risk, more upside.
Exactly.
Yeah.
So that's kind of how we think about it too, in terms of where is the opportunity and what is the risk. So the risk reward, while the reward might be greater on the underwriting side, it's actually a lot lower risk on that portfolio management side of things.
Chris, how about you?
Yeah, I think there's kind of a philosophical question to ask depending on the institution. Is the lift that you're looking for a revenue-based lift, or is it a member-based lift? Are you actually circling in on trying to retain and have super high quality members? Are you trying to grow and like drive revenue, and that's actually what you're proving out with your business case? You're going to get the answer from your boss is both. But there's likely something that is core to the ethos of your institution that is really what you're circling on to solve for. And so like I like to approach the business case building with partners in terms of what is it really that you're solving for there? And then how do you build the concentric circles of opportunity? How do I look toward where I get started in second look origination, break that down into I already have deposit data for my deposit members, or I need off-us data, and then work toward full customer lifecycle management. Great, I can now do this. I can get into into account management. I can start looking into things like early delinquency sign, proactive line management. Line management in particular is like very powerful one on the business case building side. And so it really is showing the impact across the customer lifecycle, what it's doing to you as an organization, like positioning wise, and then actually digging in on where do we get started. And that's where we find a lot of people, to your point, a lot of people find that ROI on the originations front. And as you know, Nova has a lot of visibility into helping people who have been otherwise boxed out of the financial system into getting a financial product. And this is our amazing story that we get every couple of weeks. We just had one last week where somebody had come and actually said, the credit passport product that you guys had offered helped me get a card when I moved to the States. And this is like, I will remember that forever. Like, thank you for doing what you're doing, which is an amazing experience. So there is certainly member experience attached to that revenue gain as well, and a very sticky revenue experience in which you can offer this to a consumer.
Yeah, I mean, I think the member experience side, particularly as we sort of head into the next era of competition, is going to become more and more strategically important. So it does feel like a good time to explore that use case. That is all the time we have. Please join me in thanking these guys.
This episode is brought to you by Nova Credit. Whether you're expanding credit access for newcomers or deepening risk visibility across gaps and beyond, Nova Credit lets you unlock credit bureau, cash flow, and alternative data through a single FCRA-compliant platform built for today's credit decisioning. Learn more at novacredit.com.